Hi, welcome back to another edition of Lipper's Fund Flows Insight Report. My name is Tom Roseen. Thanks for joining me today. I'll be reporting estimated net flows for the mutual fund industry for the week ended Wednesday, May 13th, 2020. Investors actually injected about $26 billion into the conventional fund business this week. It's the 11th consecutive week that we've seen net new money come into the group, and has been the story for quite some time. Most of it's in money market funds. Now, we had a really strong week this week as far as performance goes. Up until Friday, and this is the prior Friday basically, we saw that investors were basically in anticipation of the doing soft reopenings of the economy by governors in certain states. They were basically bidding up the market quite high. And in fact, we saw that the NASDAQ actually went into positive territory for its year-to-date return. It's the only group that did that. But again, very narrow leadership as far as markets go. We see that tech stocks actually have done very well. Now, on Friday, we got some disappointing news, and I think everybody expected it. We saw that the unemployment rate actually jumped to 14.7%, and we saw 20.5 million people lose their jobs. Now, a lot of people actually cheered this and said, this is better than we thought it was going to be. We thought it was going to be 22 million people. And in fact, because 18 million of those 22 are saying that, or of the 20, are saying that it's a temporary unemployment, they kind of blew off what was going on. Well, a dose of reality came in as Fed Chair Powell actually got on record with the Senate and said, this is probably one of the worst, steepest depressions that we've seen all the way back to the Great Depression. Now, the Great Depression had a 25% unemployment rate, so I don't think anybody was trying to say that, but it was the scope and the depth and the speed of that decline that really took people off guard from his remarks. And in fact, Powell actually came out and said, one of the things that may be considered, and he obviously not a lawmaker, is that there could possibly need to be another $3 trillion in assistance to keep the economy going and to avoid any long-term, as he said, issues in the economy. So I think people really got that dose of reality and really kind of backed off on things. Now, that said, we still saw the NASDAQ actually finish the week, Wednesday to Wednesday here, for Fund Flows Week. Basically, the NASDAQ was up 0.10%, so really not a lot to write about. But on the flip side, as we take a look at SP and Dow, and particularly the Russell 2000, we saw a 2.36% decline for the Russell 2000. So the other indices did not do that well this week, and again, a dose of reality kicked in. Well, let's go ahead and show you actually on a play-by-play, but first we'll do a kind of macro group review of what happened to the fund flows this week. We saw that equity funds lost about $1.4 billion. Taxable bond funds took in about $6.7 billion. Municipal bond funds took in a nice $383 million after having a couple of weeks of outflows. And then money market funds, as has been the story for quite some time, basically took in the lion's share. In fact, not the lion's share, virtually all the big money. $20.3 billion went into money market funds. So this has been kind of a story that we have been talking about for quite some time, and that is the investors basically setting themselves up for future purchases. Now, again, a lot of people were worried about the buy high, sell low. The market was doing so well up till December, even January. And then we took the huge drop in February, particularly in March. We got hit, and so a lot of people jumped out probably at the wrong time. But at least we see that people are putting money from their bank accounts, and we'll show this a little bit later on, from their bank accounts, and instead of not investing at all, at least they're still putting money to work in money market funds, which would tell us that they're getting ready to start their savings plan and start allocating back to equities and fixed income. Well, let's go ahead and take a look at equity funds for that matter and see what happened to the group for this week. Basically, we saw that for the second consecutive week that we had outflows. Actually, third consecutive week that we saw outflows, and this time it was to the tune of $1.4 billion. And for the second consecutive week, they lost money as far as returns go, and that was a 0.45% loss. And if we dig a little bit deeper, we see domestic equity funds actually saw positive flows, but only to the tune of $29,000. In the past, you've heard me talk about that as a rounding error, but nonetheless, it was not negative. And we say that the inflows were the first time in 3 weeks that they've seen inflows, and they also had a negative return of 0.91%. That was the second consecutive week that they've seen negative returns. Now, on the non-domestic side, we see that they saw about $1.4 billion in outflow, 6 consecutive weeks that they've seen outflows out of that group. But on the flip side, they actually saw some pretty encouraging things, 0.56% return. Again, that's not anything to write home about, but certainly it tells us that investors are not necessarily following, at least on a week-to-week basis, the returns, chasing returns and the like. So 0.56 plus side return, fifth week in 6 they've seen plus side returns. And we do a little deeper breakout. We see large cap funds lost about $672 million, but science and technology funds took in about 796. Again, very narrow as far as the leaderboard goes, but nonetheless we are seeing technology, and that does add quite a bit of business to our business models, right? With automation and the like. But $796 million went into that group. Now, at the bottom side, on the world equity side, we see international equity funds basically lose about $1.1 billion, and global equity funds actually lost a little bit as well. Well, that kind of, again, brings us to this story of how did mutual funds do in comparison to ETFs. So let's go ahead and take a look at the ETF side of this equation and see that for the third consecutive week, we had outflows out of equity ETFs, $1.1 billion this week. But we saw SPY, the Spider S&P 500 ETF, taking about $3.5 billion. We see Invesco QQQ, Trust One, basically taking a $1.1 billion. And again, that makes total sense because we saw that the equity funds did very well as far as doing that type of stuff, right? To actually just getting positive returns and the like. But on the bottom side, the small cap group, iShares Russell 2000, lost money, about $1.9 billion out of that group. And then the iShares MSCI Emerging Market ETF basically lost about $1.1 billion as well. So one thing that we did see here was that there was a commonality, right? We saw that equity funds lost money together, both on ETFs and conventional funds. And we saw the same thing in the fixed income arena. Let's go ahead and take a look at the fixed income group and see how that panned out as far as flows went. For the fifth consecutive week, they took in net new money. So the conventional funds fixed income group took in $6.7 billion. It's a second week in 3 now that they've had plus side returns, but this time only to the tune of 0.06%. And what we see is the Fed stepping up and providing liquidity services. Basically, they went to their lending facilities and said, we're basically going to do whatever it takes. And in fact, this past week, and we'll talk a little bit about this in a second with ETFs, they even entered the ETF arena as far as buying bond ETFs in order to provide liquidity. And I think that's what part of the panic was several weeks ago when we saw huge negative returns, 4 or 5% declines, huge outflows out of the group, is because people were concerned about the credit worthiness of these funds and what they were going to be able to do. And then also, not just the funds, but anything in the credit, and basically taking a look at some of the liquidity issues. Will firms be able to meet their debt obligations? And basically the Fed has said, yeah, that's what we're going to do. We're going to make sure that they are able to meet those obligations by opening up a lending facility and working within the groups to do that. So as we're taking a look at this, basically the big winners here, corporate investment grade debt funds took in about $3.8 billion. Corporate high yield funds, again, people willing to go out on the spectrum, going up for a little bit yield, $3.6 billion. But on the downside, we basically saw that the government mortgage securities lost about $443 million. Not a lot to write about on that one. But interesting enough, when we turn our attention now to the ETF side, they're in agreement again. And again, over the weeks we've been talking about this, ETF investors, authorized participants, and the retail investor are often at odds with each other and kind of going in the opposite direction. This week, though, we see that mutual fund investors and authorized participants, those guys who create and buy and sell and destroy ETFs, basically were able to agree, at least as far as in direction of what was going on. Let's go ahead and take a look at the ETF arena and see what happened with them. So basically, we take a look there. We saw for the 7th consecutive week, they've taken in net new money in the fixed income ETFs, this time to the tune of $3.7 billion. The main attractor of money was the iShares iBox high yield, dollar high yield corporate bond ETF, which took in about $830 million, and the iShares Core US Ag ETF took in about $739 million. Now, as we would expect with people becoming a little bit less risk averse and more risk seeking and really in search of yield. The iShares 20 plus Treasury bond ETF lost about $430 million, and the iShares 7 to 10 year Treasury bond ETF lost about $377 million. Again, not a big deal as far as those type of issues go. It was basically an agreement. A little bit more risk on, a little bit more in search of yield, and not so much in seek of Treasury or safe haven assets at this time. Well, that brings us now to another area that has been really quite an attractor of assets, at least until the end of the year of 2019. That was munis. Muni bond funds actually took in money this week to the tune of $383 million. It's the first week in 3 that they've actually seen net new money come into the group. And let's go ahead and take a look at the picture overall to get kind of a view of what's going on. Second consecutive week, they've actually had plus side returns, this time to the tune of 0.47%. Now, this is a 1 week return, and these are muni bond funds. So you notice that on the right-hand side of the screen, upper part, you see 0.47% says change due to market. Those are market returns. And then we saw a 0.83% return for the week prior. But again, if you go back over the prior weeks, we saw some big losses. But nonetheless, people are changing their tunes because, again, the Fed came out and said, listen, not only are we going to try to help municipalities, but we're going to go to some of the smaller municipalities as long as they're highly rated. So what we're seeing is people change their tune a little bit and say, listen, we're a little bit more comfortable because the lending facility at first was just going to go after highly rated big organizations and big counties and big cities. And now it extended that reach down to smaller cities and smaller counties to take care. So what we saw was short municipal debt funds actually taking about $319 million. We saw intermediate municipal debt funds taking about $208 million. However, on the flip side, and this is where they get a little bit more punished, is the lower rated, the high yield muni debt funds actually saw outflows of $199 million. Now, if we take a kind of additional look, we see on the ETF side, muni bond funds actually took in about $259 million this week as well. I'm sorry, lost about $259 million this week, very similar to their retail brethren. So now that brings us to the final group, and that is money market funds. And as I said, for the 11th consecutive week, they have seen net new money come into that group, but this time to a lesser extent. So we're not seeing the mass, sales and panics and, $100, $200 million in a week. We're seeing something a little bit more realistic, $20 million. But we do know that a lot of this money actually is not just coming from the sales of other securities or other ETFs or other stocks. It's actually coming from our banks, from our wallets. Basically what we're doing is we're getting paid and we're putting money to work into money market funds in anticipation of being able to put it back to work in equity, muni bond funds, and taxable bond funds. Probably other securities as well. But again, a lot of people have said, listen, there is no such thing as money sitting on the sidelines. Yes, there is. And this is the case. What we're seeing is net redemptions from equity and fixed income and muni bond funds and the like. But it's not a perfect offset. In fact, we're seeing $1.1 trillion year to date come into the money market fund arena. Now, some of that is obviously redemptions from ETFs and mutual funds and the like, but it is certainly probably 3 to 4 times more amount into money market funds. And so instead of people doing automatic monthly investments in their equity funds and their taxable bond funds and their muni bond funds, they're actually putting it to work in money market funds. That's a plus. Obviously it's a low yielding piece for the money market industry, for the industry as a whole, but it does tell us that investors, once they think some of this is behind us, they will start putting money back to work. Let's go ahead and take a look at that slide to see what's been going on. So again, as you can see up here, basically I told you 11th consecutive week they've taken in net new money, this time to the tune of $20.3 billion. And by the way, it is one of the lower numbers that we've seen, so slowly declining. And how that broke out, those taxable money market funds took in about $21.1 billion, and we break that down into the subset, institutional investors, basically, and when I say institutional in this case, Really, it is our 401ks and 403bs and even maybe some IRAs that are out there that are actually, and some corporate treasurers, but basically the funds you and I have, in our 401ks basically have set these up as a low cost provider of money market fund instruments. And so that $16.9 billion is a combination of probably institutional players and then 401ks and the like. Retail investors, though, put in about $4.2 billion into this group, and tax exempt money market fund investors actually took money out $846 million. But again, we told you that there's been a net inflow into muni bond funds, only $383 million, but it's certainly net new money coming into muni bond funds, so a little bit of outflow was certainly expected at that. So basically that kind of brings us to the end of this conversation. And we basically know that we're at the end of the earnings season, and so I think people will really start turning their attention back to economics of the world. I mean, certainly we've had, according to our Refinitiv research team, basically we've seen that they've beaten expectations. Companies have beaten expectations, but they're not providing any guidance. So like 68% of all the industries out there actually have done better. If funds have done better or stocks have done better than analysts had expected, but this was by lowered expectations, right? And so a lot of investors are kind of saying, listen, we need to see what's happening with the coronavirus. We need to what's happening with the Congress as far as will there be another bailout package, another $3 trillion. There's good and bad things about both, and I think that's what people will be keeping an eye on. So as we're in the wind down stage, we'll pay more attention to the COVID-19 news. We'll take a look at what the central bank has up its sleeve. And basically, we saw today that April retail sales dropped 16.4%. That's a disaster. Again, we expected that, though. Nobody's been out buying anything. But will this money that we've been getting in our paychecks and for people that are unemployed, the extra $600 a month or a week that they're getting, will that translate into greater demand? And I think a lot of people are certainly hoping that would be the case. Well, if I haven't done a deep enough dive for you and you want to do a little more digging yourself, you can go to our site at flows trends for the week. Well, thanks for joining me today. Be well. I'm wishing you the best in your wealth planning and creation, and look forward to seeing you once again. Thanks. My name's Tom Roseen. Wishing you a good day.